Welcome back to Yield Report Daily, the channel dedicated to making personal finance simple and accessible for everyone. Today we are talking about stock investing, and specifically 5 widely discussed rules that personal finance educators and long-term investors point to again and again as the foundation of a sensible approach to building wealth in the stock market. Before we get into the rules, one important thing to understand. Investing in individual stocks is not the only way to invest in the stock market, and for most beginners, it is not even the recommended starting point. We have dedicated videos on index funds and dollar cost averaging on this channel that are worth watching if you have not seen them yet, and we will link those below. But stocks are a huge topic. Millions of people invest in them, and understanding these 5 foundational rules will give you a much clearer framework for thinking about any investment decision in the market. Rule number 1. Invest only money you can afford to leave invested for a long time. This is the most fundamental rule, and everything else builds on it. The stock market goes up over long periods of time, but it is volatile in the short term. Any given year, any given quarter, even any given stretch of 2 or 3 years can produce losses. The investors who get hurt badly are almost always the ones who put money into the market that they needed in the near term, then had to sell at a loss when the market was down. The widely discussed guideline is that money you invest in stocks should be money you will not need for at least 5 years, and ideally 10 or more. If you might need the funds within a few years, that money belongs in a high-yield savings account or a similar low-risk vehicle, not the stock market. This is not about being overly cautious. It is about giving your investments the time they need to recover from downturns and grow. Markets have historically recovered from every crash, but only investors who stayed in long enough benefited from that recovery. Rule number 2. Diversify, and never put all your eggs in one basket. Concentration is one of the most common ways new investors take on far more risk than they realize. Buying heavily into a single company, or even a single sector or industry, means your financial outcome is tightly tied to the fate of that company or sector. If it performs well, great. But if it struggles, your entire portfolio struggles with it. Diversification is the practice of spreading your investments across many different companies, sectors, and sometimes asset classes, so that the poor performance of any single holding has a limited impact on your overall portfolio. An index fund that tracks the broad market is one of the most commonly discussed tools for achieving this, because a single fund can give you exposure to hundreds or even thousands of companies at once. For investors who choose individual stocks, diversification means building a portfolio with a range of companies across different industries, so that a downturn in one area does not torpedo the whole thing. It also means avoiding the temptation to overconcentrate in companies or sectors you personally know well or feel excited about. Familiarity can breed overconfidence. Rule number 3. Understand what you are buying before you buy it. This sounds obvious, but it is one of the most frequently violated rules in investing. People buy stocks based on tips from friends, trending social media posts, or the feeling that a company is cool or popular. That is not investing. That is speculation. Before investing in any company, widely discussed due diligence involves understanding what the business actually does and how it makes money, whether it is profitable or on a credible path to profitability, what its competitive position looks like in its industry, and what risks could hurt its performance. This does not require a finance degree or access to sophisticated tools. Most of this information is publicly available in a company's earnings reports and investor relations materials. The broader point is that buying a stock means becoming a part owner of a business. If you would not buy the whole business, you should understand why before you buy even a tiny slice of it. Rule number 4. Do not try to time the market. This is perhaps the most counterintuitive rule for new investors, because the impulse to wait for the perfect moment to buy or sell feels logical. The problem is that markets are extremely difficult to time consistently. Even professional fund managers, with teams of analysts and decades of experience, fail to consistently outperform the market through timing strategies. The data on this point is stark. Multiple long-term studies have shown that missing just the 10 best days in the market over a multi-decade period dramatically reduces your overall returns compared to simply staying invested the whole time. And those best days tend to cluster near the worst days, meaning investors who panicked and sold during a crash often missed the sharpest recoveries that followed. Dollar cost averaging, which we have covered in a separate video, is widely regarded as a more reliable approach than timing because it removes the decision entirely. You invest on a regular schedule regardless of conditions and let the market average work in your favor over time. Rule number 5. Think long-term and manage your emotions. Stock prices move constantly, and the financial media reports on every move as if it is significant. Quarterly earnings misses, interest rate announcements, geopolitical events, analyst upgrades and downgrades, all of it generates noise that can feel overwhelming and urgent. For a long-term investor, most of it is irrelevant. The investors who build wealth in the stock market over decades are generally not the ones who react most rapidly to news. They are the ones who build a plan based on sound principles, invest consistently, and resist the urge to make emotional decisions based on short-term market moves. Selling when markets are falling and buying when everything feels exciting are both forms of emotional investing that tend to hurt long-term outcomes. This is easier said than done. Watching the value of your portfolio drop is genuinely uncomfortable, even when you rationally understand that markets recover. Building the habit of checking your portfolio less frequently and thinking in decades rather than days is a discipline that most experienced investors say takes time to develop. To bring all 5 rules together: invest money you do not need for the long term, diversify across many holdings, understand what you are buying before you buy it, stop trying to time the market, and make decisions based on a plan rather than emotions. These 5 rules will not guarantee any specific outcome, and nothing in investing ever does. But they reflect a framework that long-term investors and personal finance educators consistently point to as the foundation of a sensible approach. As always, nothing on this channel is financial advice. We are here to educate and explain. Your own situation is unique, and for personalized guidance, a qualified financial professional is the right resource. If you found this video useful, please hit the like button and subscribe so you do not miss our next one. We publish new personal finance videos twice a week, and there is always more to cover. We will see you in the next one.